Welcome to the Four Pillars of Investing. Andy Tanner here. We're going to begin now our study on the third pillar, which is cash flow. So just a huge congratulations to you on completing fundamental and technical analysis. Let's take this information and put ourselves in a position where we can benefit financially. Now, when you're on an airplane and you're excited to get to your destination, before you take off, the flight attendant comes to the front of the cabin and begins her safety talk or his safety talk. And you see people tune out and say, oh, gee, we just want to get going here. We've heard this 1,000 times before. You know what? If I were taking you on a river trip, on a raft, and I knew there was white water, I knew there were rapids down below, I'd feel so much better if you and I just started with a safety talk. Hey, it takes 5 minutes to do. Oh, really? 5 minutes? Can't we just get to the money? Yeah, we're going to talk about risk too. And we're going to put these pillars next to each other for a reason. They're bonded, welded, sealed, married, fused together, intertwined. We always speak about them together, not separately. So while we'll finish with a wonderful segment on risk management, we'll send you off beginning to practice with some good solid risk management knowledge. It's also appropriate to speak about risk at the beginning of the journey. So we'll take a few minutes here at the beginning, and I get nervous because I want to get going, and I know people live in a world where things are taught in 2 minutes. But I'll tell you, this is professionally important to me. It's personally important to me, and we're going to start off with a very important word. I take this very seriously, and I will not apologize for it. And we're going to speak about one of the things I believe helps people lose more money than perhaps any other thing in this industry. It's called temperament. Warren Buffett, boy, what a great person to study for knowledge, and Munger as well. But what a perfect example, really, a perfect example of temperament and how he deals with things emotionally. I think as much as his education has helped him, I think his temperament might have been a real key, as well as what he knew is how he approached it. Very mature, very wise, with a great temperament. Now, why begin a risk management discussion with temperament? Well, I know what this does. This is going to be one of the most exciting pillars you've ever seen. This here is going to give you so much hope and so much enthusiasm, and you can say, my gosh, these are simple. This is simple. I mean, this is cool stuff. This makes sense. I feel like I've known this my whole life. It's just been put in a context of clarity where I can do it. You're going to have incredible excitement. This is such a cool pillar to go through. It's the one everyone loves. Hey, we named our academy after cash flow. It is awesome. I also know what it does to temperament. So our safety talk here is going to be thus. I'm also going to take a privilege to be vocal about something. It's easy to live, just like, Paul McCartney says, just let it be. But there's also times to be vocal. So I'm going to choose to be vocal here, perhaps at my own peril, but I don't care. It communicates how passionate I am about this. As a fellow student, I travel the internet, and Google, it tags me with algorithms just like it tags you. And apparently Google feels I feel strongly about investing, and so I get many advertisements and people telling me, hey, Andy, I'll teach you how to trade options or stocks or whatever. And I have to say that while some I've been impressed with, most, and I say that, most I've not been impressed with. And these are my peers, so I'm going to chime in just as they have. They felt free to put their word out there. I'll put mine out there too. And I'll give a couple examples. I saw a guy, some dude, I've never heard of him. He's in a private jet. He says, I'm the greatest option trader in the world, and I'll help you learn all my secrets and blah, blah, blah. And the temperament he's creating, I just don't feel it was a mature, appropriate picture of what this is like. I saw another guy that I think he was doing penny stocks or something, and he dumped $1 million in cash on a coffee table, and he was talking fast and all this. And maybe these guys are the best traders in the world. Maybe they could out-trade me any day of the week. Maybe they could. I'd be happy to take the challenge. But I'll tell you this, their temperament in how they portray this with just reward, with no process and no risk mentioned, I don't believe the temperament that those messages created are the temperament that makes a successful trader. The other reason I say this is because I have 2 sons, And someday they'll get old enough to take their dad's classes. They may or may not. But when they do, it's important to me personally. I said, this is fun, simple, and real. We are not interested in having every possible student in the Cash Flow Academy. We've had many, many meetings on this, that there are just certain temperaments that we just don't think are fun and simple and real to teach. And so, hopefully you found your way here because of the rewards, but you've also had an appreciation for how we approach this in a mature manner, that something I can be proud of, something my sons can be proud of, and something you can be proud of, rather than just the zaniness of a crazy temperament. So with that, let's approach, that's a perfect primer or a springboard into our disclaimer. I'm going to give you some illustrations of personal trades. We'll attack those one at a time. Sometimes I use Acme and ABC and XYZ just to do a point, but I've also been very appreciative of my own teachers, especially my real estate teachers, that often they'll use real examples, and it just helps me have confidence that this stuff is real. So I'm going to give you some real trades that I've engaged in. My fear in doing that is twofold, is that you would construe that as advice, say, oh, I'm just looking for a fish and give me that fish and I don't care if I learn anything. So no advice. I'm using these to illustrate. I almost hope that after they don't work out and I have to use some risk management because you never know when a trade's going to work out or not. But here's the example I always use, just like that flight attendant telling you where the exit is for the 50,000th time. I'm going to give this to you for the 50,000th time. It's like gold. If I say buy gold or don't buy gold, that's advice. If I say gold is fungible, now we're beginning to learn about gold. So advice. Also, the claims. The math on these investments that I'm going to show you is impressive. At least I believe it's impressive, and it's very exciting. It's not a claim that you can get the same math I do. It's not a guarantee. There's a mentality of the amateur trader, of the employee, of the non-investor mindset, the non-entrepreneur mindset that needs guarantees, and they just think they're not going to make it. And we'll speak about that as well. They're not going to make it because their mindset is wrong. And a mind cannot solve a problem cannot be solved by the same mind that created it. You either bring in a new person or change that person's mind. And so I get nervous about showing math because people say, well, see, Andy said this, he guaranteed. No, I did not. We gave no warranties whatsoever. I will protect myself and I will protect you to the degree that you're willing to be protected. This stuff is risky. I'm going to do some naked calls. And that's not a 4-pillar strategy. We teach those in the Ultimate Option Strategy, but I show them to illustrate the point of premium and how to bring in premium on demand. And that's the only reason I show it is to teach a principle, not to recommend you could do that, okay? Because you're not at that level yet. At least, well, I don't know what level you're at, but if you're approaching this as a beginner, which many people do, that's not a place to start trading. So there's risk involved for me, and that's why this disclaimer is so important. That's why we don't gloss over it, and particularly in the cash flow. And I know that took a lot of time, and I thank you and I appreciate you for giving me the personal privilege of communicating the seriousness of which I take this. I know people are antsy. We live in a world where things are done in 30 seconds, but I appreciate your willingness to establish the context and understand this is about education, not about a poor temperament or recommending or advisory. So thank you for that personal privilege. What's in this for us? Look at that list. It's the biggest one in all of the pillars, and that's not even comprehensive. So we're going to really pay attention to Warren Buffett and compounding, lots of different types of positions. We're going to hit dividends hard. We're going to really hit infinite return. Certainly 1%, 3% have its place. I was disappointed with the Nigerian brothers and their commercial on CNBC where they said, here, you would have had 500% on this trade in 8 days. Well, you know what, Pete? You know as well as I do that you've had ones that didn't work out in 5 days. You've had down an exit strategy. Those are some of your best that you're putting out there. So I understand big return. And there's a place for the 1% return. There's a place for getting out and getting no return. But the law of infinite returns is what we're going to go for. So that's very, very important. Okay, let's talk a little bit about this. Let's set our context. The greatest seed cannot grow in stony soil. So let's review our context once again. We do this with every pillar. It's just like our warm-up before we get going in our workout, right? This is our 5 minutes on the treadmill to get our body ready to work out. Is we do not have the perception of saying, oh, I won't know this today, but I will know this tomorrow. We'll have the reality perception, says this will take some time, and over practice we'll get there. Easy. Next warm-up, next context. 2 journeys to make, from ignorance to knowledge, and then from knowledge to behavior. To know what to do and then do it, I'm completely unapologetic when I say get a coach. It makes a difference. It will make a difference. Behavior is key. Knowledge is great, but behavior is what makes things happen. And then the education continuum has many purposes, but the number one purpose is humility and meekness. I've seen it too many times where we illuminate someone and now they have a self-concept of proficiency rather than illumination and awareness. Just because a person learns a little bit more about dividends today doesn't mean they're proficient in dividends. My friend, mentor, Robert and Kim Kiyosaki are precious to me. I've spent many hours with them in different meetings, both as a student and as a teacher. And one of the things that Robert Kiyosaki has said that I think is a great insight is the concept of what he calls functionally incompetent. He says one of the challenges school has is to get people A's, and that there's this feeling that I'm, again, just as a person who's aware thinks they're proficient, perhaps someone who's made the jump to competency now has a self-concept of proficiency. Those are dangerous self-concepts. A great metaphor perhaps would be a piano player could study books and music theory and get A's on all the tests and be unable to perform in a concert because they haven't put the time in the piano to be functionally competent instead of just intellectually competent. There's a big gap between between an intellectual assent to a truth and the ability to apply it in the real world. I would say the chasm between competency and proficiency on the basketball floor is astounding. You know, as a coach, it's pretty easy for me to know all the answers. It's so much more difficult to play than to coach. So much more difficult. I can know the playbook inside and out, regurgitate it, the coach, get an A on that test. But on the floor, in that kind of pressure and difficulty, execution is huge. So the education continuum keeps us humble and helps us say, hey, where am I really? Where do I want to be? And it makes me feel good about my progress. So in the 4 pillars, hopefully we're dipping our toe in this. And with the coaching programs, we start dipping our toe in this. And that's a good thing. Here's a new one I've added because it's cash flow. And I talked about the mindset that is fatally flawed. A person will not be a successful entrepreneur with an employee mindset. Let me say that again. A person will not be a successful investor with an employee mindset. A employee mindset will be good for employees. An investor mindset is good for investors. I'm weighing in, very dogmatic on this. That's it. People live in fear, and I think fear is the biggest thing that stops people from starting their own business, from investing well, because they live in fear of losing. And the idea of going into investment and having a loss just mortifies people. I have lost so many times, I can't count them, times I've invested and lost. In business, actually I've never had a loss in real estate yet. But we've had plenty of losses in stocks. And so people will come and say, well, how much should I make in cash flow? What's the average guy or whatever? Man, it's across the board. There is no average guy that I've been able to get a metric on. But I will tell you the mindset is interesting. You know, I'll do whatever if you do whatever I say, I'll pay you. And this is why people ride this, get chase that cash right there, which is actually something that's going down in value. It's not really an asset. It's a medium of exchange. But that's what they do. They chase stuff that's going down in value because they want a guarantee. over here, I will tell you when people say, how much can I realistically get? I would say you're going to wind up somewhere at one end of losing everything you have. It's not in between that. You could actually land in losing everything you have on this end and having $1 billion on this side. I mean, it's just somewhere on that continuum, and that's really is it. So we're going to get comfortable with the idea of investor mindset as we go on, because every single investment I've ever gone into, I thought I was going to make money or I wouldn't have gone into it. And that reality that it doesn't always happen is a huge, huge thing. So with that, let's hop in. Information, we say, how strong is the entity? How strong is the market? That can't hurt us. Over here, cash flow, how are we going to position ourselves for profit? And then how are we going to deal with it if it changes? Because this is where we want to minimize losses on changes. So we'll focus now on positions. Let's look at two. So we've alluded to this a little bit. Let's really solidify it here at the beginning. Is there's two positions you can take, and a combination of these two main ones. You can have positions that have an impact on your net worth, where that's the goal, and you can have positions to build cash flow as a goal. For example, gold, they have this concept called carry. To carry gold, there's not a lot of cash flow to that, right? It just sits there. And if the gold goes up and down in value, assets minus liabilities equal net worth, obviously fluctuations in the gold would cause fluctuations in the net worth. Same with stocks, same with real estate, right? And so forth. Over here, we'd have the cash flow where we'd say, maybe I use the ETF of gold and I write a put to acquire some. That would be affecting your cash flow. Maybe the stock pays a dividend. That would affect your cash flow. Maybe you have rent and that affects your cash flow. So over here, we have a concept called delta, which is price change. And over here, we have theta, which is time change. So we have 30 days going all the way down to 1 day. Or we have $100 going up or down to 110 or 95. There's changes in price and changes in time. And now would not be too early to introduce the idea that often a theta comes monthly or quarterly. A dividend might be paid quarterly. Rent might be paid monthly. Notice these are over time. A dividend is the profits you made from a company over a period of time. Where here, net worth changes often are related, not always, but this is a good way to begin to frame this, is we're looking for a price change. So those are two elements to ask ourselves when we position ourselves, is to say, okay, are we looking to profit because of a price change, or are we looking to profit over time with a time change? And then see if we can associate that with what's called a capital gain over here, or what's called cash flow over here. And I say capital gain not in the tax sense, because they could both be taxed as capital gains. I'm just talking about buy low, right? Let's just put it this way. This is buy low and sell high. That's usually what we're trying to do with this type of thing. Over here, this might be rent or over the month, or a dividend over the quarter, where the price of the house did not impact the income from the rent, and the price of the stock did not have a great impact on the size or frequency of the dividend. Where the dividend is usually about the profits and the earnings, the rent is due to the contract, where the actual prices are there. So separate the idea of price movement from cash flows that don't require a price change. I don't need a price change in a stock to get a dividend, and I don't need my house to increase or decrease in value to collect rent. And so those are some things in positioning to begin getting your mind around as we talk about the Cash Flow Academy and how we approach this. We're going to teach both capital gain and cash flow. You can probably tell which one we're partial to, but we will learn both. We'll learn both strategies here in the 4 pillars of investing. We'll introduce both. Think about how huge an understanding of that concept is when you reflect on the major change in retirement. You know, when you looked over on this side, look at how this works. This is about cash flow. The assets and liabilities are not even touched in this idea. And so the idea is this was a cash flow because you got income from a pension to pay your new bills. This retirement plan was cash flow based. Here, this one is capital gain based, where we're trying to grow a 401k large enough that it'll last us till we die. And so that little change from defined pension into 401ks was a fundamental change that went from cash flow, where your retirement was based on the size of your pension check that would last indefinitely, to the hourglass of the, if I can draw an hourglass well, to the hourglass of the 401k, where you could actually run out of money. So again, the idea of capital gain and net worth as opposed to a retirement of cash flow. So we'll be, we'll be speaking about several positions, and we have a bullish position. When I say here is a bullish position, we feel that we will gain from price movement. We think that the price will climb, or by owning. This is when we would own something, or what we might call a long position. So if we own something, you know, long means we own something. And our financial statement, let's just draw this like this. We think the direction is up, and our financial statement would be here, where we own something, and we think it's going to increase in value. And there's nuances to this, and you know, an engineer would nitpick and find the exceptions to it. But basically, for a beginner level idea, let's begin with the idea that we're entering this type of investment where we feel there'll be a change in the price, and that's called a delta trade, where we feel that, you know, the price change is going to benefit us in some way. So we would own something in their asset column. Over here, we might feel something's going to go down, and so we would not want to own it. What we'd actually do is we would borrow it, and we would have a promise. Okay, some promise is liable. This is a little bit harder for people to understand. We'll get into it. We're not going to go further than this, other than that's just say, look, however this mechanism works, we'll get to, but we feel comfortable in the idea that, okay, there is a way, whatever this looks like, there is a way to make money when things go down with a price change. And then there's time change, and time change could be with markets going up, down, or sideways. And we're not really looking at making or losing money with the price movement. We'll look at a benefit or a cost of holding it over time. And this has a lot to do with the options and the dividends. If we own an option over here, if we own an option, we're going to have, that's going to be negative effect on our time. But if we've made a promise connected to an option, that's going to have a positive effect on our time. Now these are I don't expect you to understand this part, or this part right now. I do expect you to get your head around the idea that we can make money when price go up, we can make money when price go down, we can make money when price is stagnant because of a time change. We'll get into the weeds, we'll get into the details, but this is about positioning. As we look at the 4 pillars of investing, this is about information. This is about action. You'll notice the word is position. So it would make sense that we would begin, if we're going to take this information and use it to position ourselves for profit, we would talk about different types of positions, such as a position for a capital gain. Put ourselves in a position of benefit here. A position for cash flow. A position where we can benefit here, right? A position when prices go up, and positions when prices go down, and positions where prices go sideways. Another thing we can do with our position is we can take a position of leverage. I don't expect you to memorize all these positions, right? Capital gain positions, bear positions, bull positions, time positions, positions where we leverage a bank's money, positions where we leverage technology, positions where we leverage cash, positions where we leverage a contract, and positions where we leverage other people. You know, this is what we call OPM, other people's money. This is what we call OPE, other people's experience, other people's education, other people's endurance, other people's excitement, other people's enthusiasm, other people's energy, other people's expertise, other people's experience, other people's everything. This is what business really is right here, is leveraging not only other people's money, but other people's everything. And this is very much a pillar about leverage. And its wise use, its unwise use, the risks involved with leverage, and the returns can be fantastic. But understanding leveraged positions is going to be key. So let's not go too quickly, okay? So we have position, we have the idea of positioning ourselves for profit. So our position could be for a net worth increase or hopefully a cash flow increase, right? Our position could be one of bullishness. Our position could be described as bearish. Our position could be described as time decay. We could also describe a position, say he's in a leveraged position in his real estate. He's got a lot of leverage, right? We could say he's positioned himself well with a good contract. You know, he's in a great technological position. He's in a good cash position. That guy can really leverage the power of cash right now. Oh, this guy has just got such a great business. He's McDonaldized everything. He's got everything positioned perfectly. He's really leveraging checklists. He's leveraging manuals. He's leveraging standard operating procedures. You know, McDonald's leverages systems better than anything I've ever seen, because you can get the lowest level employee you can find to run $1 billion corporation. Think about that genius. You know, their hamburgers aren't very good, but they have this ability to bring people, the public in, take their money in exchange for goods or services with the lowest level employees you can find anywhere, that are so replaceable by a robot. They're just so good at that. So that's important stuff. We want to have great tax position, and we want to have a good asset protection. So this means building your accountant team and attorney. I'm so grateful to Tom Wilwright, my tax advisor. He just, I just love him. We want to be positioned well that way. And then we position ourselves for rate that way. And the rate will range from 0% to infinity. And we'll talk about those positions. And when we come back, I'm going to begin by reviewing long and short positions. And we're going to come back to this one and give it its own section of long and short. And that'll be important. I will just say that long is when we own things. Let's get that into our head. And when we're short is when we've made a promise of there'll be a promise involved. And so the long positions tend to deal on this side, and the short positions you could think of it dealing on this side. Here is where you buy things. Here is where you borrow. If you want to own something, you buy it. If you want to promise something or owe something, you know, owe is another word for promise. You borrow. Long, short, asset, liability, up and down. I mean, there's all kinds of cool, opposites we'll get into. I'm going to give it its own special thing. To finish this off, this first introduction to cash flow and all these positions, we're going to go very slow. So in this first segment, I appreciate your patience in letting me lay the proper foundation and trusting me as the teacher. People want to get into the details so quickly that their soil is not prepared. So when you do give them a detail, they don't get it. If you take a moment and really soak this in, what this is about, and just enjoy it and be patient, we'll get in some great detail. We're going to finish this off before we come back and give shorting its own segment, short positions its own segment, and get into some of the Warren Buffett stuff. Let's finish off with this idea. Is over here I have a compounding calculator. You can find these, really anywhere. If we go out of theater mode, I can change these rates. And let's just play with this for a little bit. Let's say I put in a rate of, I don't know, 20% right here. Watch what happens to this number over 30 years. It gets, kind of ludicrous right here. See that? It just gets crazy. Let's take it back to 8%, okay, which some people claim has been, what the market has done. So the idea is, let's just say, what does it take to get $1 million? Now the problem here is time. If I put in 10 years, that significantly reduces this. So then maybe I bump the rate back up to something higher, right? Whoop, let's get that put in there properly. Maybe it bumps the rate up. So time is something that is a huge impact. And we have these three areas: money, rate, and time. Maybe someone's got a lot of time, but they don't have a lot of money. Let's take a zero off that baby right there. Whoop. Let's take a zero off of that. And so, it affects things, right? It affects stuff. So I challenged you in the first pillar of fundamentals to get some lifestyle goals. And the question, and then to set some money goals to pay for this stuff, and then get some education goals. This is where this really begins to be more and more important, because you can see that, the rate, there's not much you can do about the money you're starting with unless you learn how to raise capital really well, right? So you're starting with a money. If you raise capital, you're increasing your rate by increasing your leverage of OPM. And so, these are the three things you play with. The one that you cannot control is the time. And you can either be patient or impatient, on when you want to achieve your lifestyle goals. I want to achieve mine fast so I can have time to enjoy them. So what that means is I'm going to be very aggressive with rate. And this means leverage. And leverage means education. So you can see that you're going to play around with these ideas. What do you want? When do you want it? Right? Where are you starting? And how fast do you get there? And rate is about speed. It's about how fast things happen. And people often say, well, what rate should I go for? Well, I would go for an infinite return rate. That's what I would go for. I wouldn't even go for this. I would go for an infinite rate. And I'll explain to you what I mean by that. Does that mean you're going to get it all the time? Sometimes you will. Sometimes you will not. But Warren Buffett has done very, very, very well with rate. He's been in the 20% plus range most of his life, and he's stayed there very consistently, and he's made billions of dollars doing it. And started out in, 1940s probably. And over the last 70 years, he's just done he's almost 90 as of this recording. So hopefully he's with us for a few more years. It's weird doing a recording thinking that when someone watches this, he may have passed. It's a strange feeling because I don't know Warren Buffett personally, but I love him for what the example he's given me. So, that's goals, rate, and education, right? How much rate do we go for? So this is really important. Before we get into the details of how we get a bigger rate, really important to understand and be clear on what your goals are, how much money you want to have, and to make this planned as best you can, knowing that you'll make adjustments, okay? The last one we're going to talk about before we go into the next segment, we'll finish this segment off, is the power of this compounding, and just understand that this is the secret, really. I mean, it's been around for years and years and years. The question people pause and ask themselves is, have I been anxiously engaged in my compounding efforts? Have I been educated? Have I been consistent? Have I had a plan? Have I set monthly goals? What am I doing to increase my rate and my safety as I look to increase my rate? Because you can see that the person investment 1, 2, and 3, starting with $10,000 in each investment, over 20 years, the rate is just a huge difference in how fast things go. The rate is a huge deal. So just a quick review on what this was about is the foundation for cash flow. It was very much about positioning. That is what this pillar is about. Is after we learn what we think is likely, we develop a stock opinion, a market opinion, an economical opinion. We get this data and we say, okay, based on what we know, this is what we think. That's really all you can do. I said as you went through the 4 pillars, you'd get an intelligence that I always was chasing this ghost of, oh, there's something to it that isn't there. There's a secret that other people have that I don't have. There's this secret sauce that this magical power that Buffett has that I don't have. There's no magic. All we have is the data to go on. That's all we can go on is data, and then we position ourselves. When this data changes, then we deal with sudden change. So if there's one thing I can communicate is that cash flow, again, is about position, and you can position yourself for cash flow, you can position yourself for direction, you can position yourself with leverage, you can position yourself to get great tax and asset protection, you can position yourself for very, very aggressive rates or very conservative rates, and you can position yourselves long and short. And we'll be speaking about all of these and the importance of how it relates to your compounding rate. There's things you can do to raise money, but that incurs leverage. Not much you can do to slow down time here, if anything at all. And so the rate is really what financial education is about, is getting a great, great rate that can achieve your goals. The more, I don't like the idea of controlling your goals to fit a rate. I don't like that. I don't like the idea of I love Susie and Dave. Susie Orman and Dave Ramsey are disciplinarians, and they will say, look, this is what you got to do. You got to quit spending so much, and there's not a lot of creativity to that. I think there's a place for the disciplinarian, especially for the person without an entrepreneurial spirit. And that person's going to say, hey, this is what the stock market has traditionally given me. I'm going to pray that it keeps going, and I'm going to curtail my goals and the timeline of my goals to fit the rate. I really like the idea of saying, no, I'm going to up my rate to fit my goals. And that can be done. And the people who are the wealthiest in the world have not settled for low rates, Warren Buffett included. He has not settled to curtail there's this idea that, John Bogle, where he and I love, the late John Bogle and a lot of what he said, but he also was an opinion that the average person just isn't going to be able to do this. And he's right. The average person will not take a course. The average person will not work to increase their rate, and they're not going to put in the time to do it. And so they probably should curtail their goals and their lifestyle to fit their rate. I'm of the opinion that was not an acceptable answer for me. And so I've done things as an investor and entrepreneur, sometimes to my benefit and sometimes to my peril, to seek greater rate. But as I've tried to do that, I've been able to find better rates. And so that's very, very important to understand. So compounding is the 8th wonder of the world. Someone said Einstein said that. I don't know if he said it or not, but he just as well have, because it could be the truth. It is incredibly powerful. We're about to go into rate. We're going to go through about an hour of practice of different rate on different investments to sink this in and start talking about the idea of leverage. Then we'll eventually get into shorting, long, short positions, all this stuff in detail. But this is the foundation of the 3rd pillar called cash flow. It is about positioning. Positions of capital gain and cash flow, positions of long and short, positions of time decay, positions of leverage, tax advantage positions, positions of protection, positions for aggressive rate or conservative rate, long and short positions. All about how we tweak the position and the different ways we can get things done. So when we come back, we're going to start working on that rate. We're going to start looking at different kinds of leverage and different approaches to where we begin to manipulate the rate and control the rate maybe perhaps more than people thought they could. I appreciate your patience with this foundation. It's such an important foundation. I was nervous in doing this one because I thought, Andy, you're not going into a lot of details here. People are going to be upset with that. Please know that you can trust your teacher. I've taught this so long that building the foundation, the context first, pays off when you do get to the detail, which is coming up in the next segment.